And we begin this session in which I'd like to explain the core differences between an over-the-counter market and an exchange or an organized market, because they are fundamental to a Darwinex, to a broker like Darwinex, which offers trading of spot foreign exchange. The topics today, the agenda would be for me to briefly outline the core differences between an over-the-counter and a market and an exchange. I'll discuss which assets are traded in which fashion and why. You'll probably see that I don't have much respect for most of the dangers of over-the-counter markets when applied to retail counterparties. So you will more and more question why Darwinex even offers over-the-counter products. And then we will close by basically announcing something which I've announced already, and that is that we're transitioning to also offering futures. And I'd like to mention a few things then. So by all means, please feel free as ever to ask questions. Martijn is saying he can't hear anything. Can the other guys confirm whether they can hear me? Do we have sound issues? Okay, so sounds like Martijn is having an issue, which only affects him. Let me just write to him. Okay, so which assets are traded in which way? So on the left-hand side, we have regulated markets or exchanges, or whichever you want to call them. Of course, exchange-traded funds trade there. Options and futures do trade on exchange, the CME, Eurex in Europe, and so on. Equities are traded both on exchange and off exchange. There's been quite a bit of growth in exchanges light, like dark pools, which don't really meet the standard definition of a regulated market and have some element of over-the-counter, and that's why they're here. Preferred shares, again, they can be listed both on and off exchange, but there are some products which have typically and traditionally been traded off exchange for a number of reasons. They would include bonds. They also include Forex, obviously, and quite a few money market products don't list on exchange. The reasons are varied, ranging from historical to more specific topics depending on the customers that they serve. So very often the people that really buy and sell bonds, for instance, would be institutions, and they trade with other institutions. There are both knowledgeable counterparties, and many of the pitfalls that can be encountered when trading off exchange because when dealing with weaker participants like retail independent traders don't really apply there. And also another reason for listing things on off exchange is flexibility. So there are thousands of different issuances of bonds. It's not really a plain vanilla standardized asset class. So the benefits of liaising on exchange are offset against the fact that there isn't that much liquidity to begin with. So it might be just better to have individual market participants to agree to a set of contract terms between themselves and trade bilaterally. And bilaterally really is the word. So the word. We're talking about two different setups. One where different counterparties, say A and C, trade directly with each other, and in a different way from the way, say, A and E might be trading the exact same asset. So what we've got here is a network of pairwise relationships, which is really exponential in the number of market participants. This makes sense in many cases, as I've outlined. It did make sense historically when the only participants, say, in the spot Forex market were institutions who all had historical relationships with each other. They had negotiated bilateral ISDA agreements that applied to both sides. And I suspect for reasons to do with history, on exchange, basically spot never really moved on exchange the way that, say, equities or futures gradually did over over time. And as we shall mention in the upcoming slides, that has a number of differences and implications. So just to summarize, when you trade on an exchange, what's going on is that rather than A liaising directly with B, A liaises with a central counterparty, which itself has liaises with B. So by forcing everybody to go through one middleman, all the relationships are centralized in a central counterparty. And that has implications. Let's start with them. So, and guarantees that can be offered. Now, the first point is that the central counterparty has a set of public rules that apply to all participants. What are those rules? Well, for instance, there could be strict time preference, meaning that whoever arrives at the order book first gets to pick the best price available at that point. There's no such thing as one participant getting a better treatment and being able to, so to say, jump the queue, because that would be in breach of the rules, and then the exchange is in force of enforcing those rules, so that can't happen when you're talking about an organized exchange. This means that there is a single order book where all bid and ask, demand and supply lands, and resulting in matching the orders that come from both sides is a public market price that informs everyone's decision. Really, an exchange is a public good because it produces a single market-informed, supply-demand validated market price for any goods that are listed. So when you buy an Apple share on the Nasdaq, you know the price of Apple is that because that's the price at which others competitive counterparties are trading. And this is the case because everybody can access the order book. Every participant in an organized exchange can both take and make liquidity. So take would be market orders. I want to buy 1 million, say, Apple shares for the best available price. Or I am willing to sell, say, 100,000 Apple shares at whatever the price it is that it's trading right now. I don't really follow the Apple share. It's basically 100,000 shares for a price of $985 per share, or nothing. But in that case, I'm making liquidity because I'm offering a limit order that somebody at the other side can take. And last but not least, I would never know who that somebody on the other side was because the order book is anonymous. Everybody is trading against the market, the central counterparty, and the central counterparty hides the information of anyone behind the other side of my trade, which means we're both in the symmetry of information. Like I know as much about him as he knows about me, which is nothing. And that is not the case when two known counterparties are trading with each other. And last but not least, what might seem like a technical point, but isn't, given that we've had the Swiss franc and the Brexit in the last couple of years, default risk is much mitigated when everybody is netting their exposure against the central counterparty. Now, that might seem like a lot of information to take in one go, so I'm just going to work through each of the 5 points in a sequence. The first one is the single public order book. Like quite often people say the market price for whatever was this at that point in time, and that actually is an inaccurate way to look at it because really the market price is not an input but actually an output of a process. It's the output of the bid and ask matching process where competing interest to sell and so to buy an asset and sell an asset land in a single matching venue where you see the top of the book where bid and ask are closest, and then as we go down in the market depth, both grow apart. And depending on which side of the book grows faster, supply or demand, then the price shifts accordingly to make sure that both balance. So the price is really the point at which supply and demand balance given the competing interest on both sides of the book. Importantly, everybody can see what's going on here. So there's no such thing as there could be quite often with, say, Forex brokers, as one single dealer offering two different sets of prices to different customers that it can segment. For instance, and I'm not saying this is legal, but it is technically possible, it would be possible to look at, say, the traders that tend to trade with very high leverage and put those on one price feed, and the traders who tend to trade on low leverage and put them on another price feed, and just make sure that at strategically relevant times, the high leverage group got a slightly spikier price feed, so that say stop losses would be more likely to be hit, and therefore a dealer would make more profits by hitting those stop loss levels. Again, that would not be very morally accurate, but it is certainly possible within MT4. Not so when everybody is forced to trade on the same single public order book, which means information symmetry and opportunity for all. Then secondly, there's a very important point, often misunderstood. It's called the right to exercise a last look on orders. So what is last look? Well, essentially, if I'm a dealer and I've offered a certain market price, and that market price basically has been accepted by one of my customers who wants now to trade at that market price, but it just happens that the market hasn't really moved against my interests in the milliseconds that have lapsed since I published the market price until the trader accepted the market price. So I basically reserve a right of last look to refuse to honor my price promise at that point and just say, no, I'm not taking that order, and then either reject the trade or requote it at a worse price than originally anticipated, with the provision as well, of course, that the trader could have gone elsewhere if he knew that the price wasn't really available. So he will have wasted time and during such time, the price has moved against him. And that's the very reason why I rejected in the first place. So the existence of a last look is not something that is tolerated in most recognized exchanges, because it really results in basically cheating of one of the sides of the trade, but it is certainly very, very common in Forex liquidity providers. So there are rejections precisely because of the last look. So what does the absence of last look guarantee in an organized market? Well, it guarantees faster execution times, which implies there's less likelihood of adverse slippage. So yeah, last look is bad for a trader. It is good for a liquidity provider. That's why I insist on keeping it. And last but not least was this anonymous thing. So basically I mentioned before that it would be possible to segment the traders who trade with high leverage from the traders who trade with low leverage. The only reason I could do that in the first place was because I had access to the information. So really that's a bit like sitting in a poker game where some of the other guys that are competing with you can actually have a look on your cards. And that's just not good for you. So that's why an exchange that guarantees you anonymity is a better venue, all other things considered, than an over-the-counter market where a dealer knows the information that's there. So it really mitigates, an exchange mitigates the effects of information asymmetry. And last but not least, as I mentioned before, there's when shit really hits the fan and there are large movements, the dealers or participants who take on market risk can actually default when it really goes against them. And how they are connected to each other matters in that setup. So let's say C owes B 90 of an asset and B owes A 100 of that very same asset. Well, what happens if C can't repay B? Well, B has a problem worth 90, and if his capital was lower than 90, then B might presumably default because C defaulted, and then B defaults on A. Again, A, who actually did owe a lot of money to C, actually defaults as well. So they're all kind of crossed and stuck in the middle of something, even though the individual exposures the net exposures they had to each other were much more manageable. So in this case, if both A, B, and C had a capital of, say, more than 25, then none would have defaulted as a result of this movement, whereas in this case, all three actually could default. And we're talking about the same net exposure on both sides. What does this mean applied in practice? Well, actually, in FXCM's case, well, what happened was that you were trader, say, A, and this was FXCM, and FXCM owed you a bunch of bucks. It just so happens that a bunch of guys who had been caught on the wrong side of the Swiss franc euro movement happened to have lost a lot more than they had deposited with FXCM. So these guys lost all their money, more than they had with FXCM. FXCM had a huge hole of 300 million, and if it hadn't been for a last minute, basically 300 million loan to FXCM, then FXCM could not have paid back to its winning customers, which would have meant you were all happy that you thought you'd made a killing because you were on the right side of the Swiss franc move, and then all of a sudden you figure not only haven't you made anything, but actually you've lost all your balances because somebody else whom you don't even know actually blew their accounts with FXCM. So this is not just a theoretical thing; it's actually something that almost took down one of the world's biggest forex brokers. Pretty much a year and a half ago. So to summarize, what are the core differences between an over-the-counter and an exchange market? We can review those in the particular case of a contract for difference, which is an OTC instrument, against a future, which is an exchange-listed instrument, say in the case of an index links the future. So there's a single order book, as we've discussed. The liquidity is binding versus the last look. One is anonymous, the other one isn't. The counterparty risk is minimized in one case versus the other, and you know for sure that the market price in the futures is as competitive as it gets because everybody is competing to get the best price there, so they're all competing with each other, whereas you don't know if the CFD price you're getting is actually competitive or not competitive because you're the only single demand point for that price. You don't know which price everybody else is getting. So why even offer over-the-counter CFDs and spot foreign exchange if it's not, if it's so bad? Well, the first one is on the spot forex situation is that there's only one exchange that's regulated to trade FX, that's LMAX, and we actually trade with them because we like their model. Now, beyond that, it has bits and pieces of flexibility. There's only the agreement required of two parties, which means if for whatever reason the standard exchange contracts were not agreeable to both, for instance, because the minimum size of a contract is just huge, then it just makes a lot more sense to agree on smaller contract denominations, and that flexibility is only awarded because you're trading off the exchange. Secondly, there are administrative burdens connected to trading, say, shares. So if I buy a share from Martin, then somewhere in the share register of the company, it has to be written that Martin no longer owes the share, it's actually mine now, and that's an additional complication. If we're only trading and we're only going to hang on to the shares for, say, minutes or days or maybe months, then we might just say have a two-sided bet where we settle the difference in the price movement on whatever share it is that we both betted against each other, and there's no need to enter anything in any share ledger. So it's just simpler. A CFD is a simpler approach than a fully fledged transaction. I did mention the minimum trade size. As you know, futures trade with much larger minimum contract sizes, and that does make a difference. If you've got an account with 2,000 euros, you can't realistically trade futures, whereas you can trade a CFD. And also there's data. So because the exchanges know that many participants are using the exchange public data to trade off the exchange without paying commissions, which is the other way for exchanges to monetize their technological expense, then what they do is charge quite a bit for the data sets. If you want to have real-time data of what's going on in the market, you have to pay the exchange because that's the way for the exchange to monetize transactions that free ride, so to say, would free ride on the public price, but they don't because exactly they actually charge for the price. So CFDs, you don't really have to pay anything for the market data. If you're trading futures, you do have to pay a substantial amount for market data, especially for smaller accounts, and that's the core point. The amount of money you pay for data on an exchange is not proportional to your trading volume, meaning the smaller your account, the more expensive, relatively speaking, the exchange data becomes, the higher your incentive to trade off exchange and go, say, for a CFD product. And last but not least, there's the opening hours. So organized markets have traditionally opened for a set number of hours. Other markets, such as say currencies, which is fully global and therefore can't really stop when Europe sleeps, Asia is awake, and vice versa, they might have longer opening hours than would be possible even with exchanges. So there are advantages where CFDs are superior. Now, when it comes to Darwinex's offering, we've tried to keep the advantages of both. But basically, whereas 99% of the forex market are broker dealers who are trading against their bad customers and with their good customers, we are a pure broker. We never take market risk against our customers. We trade with them. When it comes to last look, we have, out of the two prime brokers that serve our liquidity, one of them, which is the LMAX exchange and the LMAX prime broker, have no last look, meaning there is 0% reject on any flow we send to LMAX. This in turn means that typically our execution time tends to be faster than the market average. So if you end up trading with LMAX, typically your trades are cleared in less than 10 milliseconds, as you can see from the public execution section that we added to the Darwinex. Whereas in many other brokers, you'll see that the fill times are actually in excess of 350 to 400 milliseconds, precisely because the dealer is exercising the right of last look. We don't have any market risk, meaning because we send all our flow to the market, short-term or basically first-order incentives for us are we don't care if customers win or lose. Second-order incentives are we want our customers to win, because the more they win, the higher their accounts, the higher their accounts, the higher their trades, and the bigger our commission revenue. And last but not least, we don't mark up the spread, but rather we charge the market spread plus a commission, which is, we feel, a more transparent way to prove that we're charging for providing liquidity, but we're not increasing the market price. We offer one and the same market price to all customers. So as I hope you've noticed, our offering is as close to on exchange as possible. We would like it to be closer to on exchange than it currently is. The ideal way out of this would be to just trade with the LMAX exchange. Unfortunately, LMAX is suffering from disloyal competition or unfair competition, in the sense that because they have a no last look policy, they have been a magnet for good traders, and because good traders tend to beat the market, the liquidity providers saw that if they offered the same spreads as they offered everywhere else, they weren't making as much money as they were with other providers. Therefore, they offered higher spreads at LMAX than elsewhere, and that in turn meant that basically the worst traders got lured away to venues with lower spreads, and it's kind of a vicious circle that forced them to integrate the LMAX exchange offering into an LMAX prime broker offering, which basically aggregates the on exchange no last look anonymous feed with a no last look feed from direct liquidity providers. So we offer two prime brokers. One is Saxo, which does have a last look, but offers slightly tighter spreads, and one which is LMAX, which has no last look, faster execution times, and lower slippage. So we try to offer the best of both worlds, because otherwise we would be in the same situation as LMAX. We would be competing in an inferiority of conditions in places where, MyFX book, where all that's published is the public price feed. So why do we also offer CFDs? Well, again, sorry that I had an issue with my computer crashing, and this is a Spanish slide. So the CFDs, when it comes to indices, offer you a way to trade with smaller contract sizes, with 24 liquidity and free data, very importantly, because if you had to pay 40-50 bucks for exchange data and you're only trading a couple of, say 1,000 euro or 2,000 or 3,000 euro accounts, then basically you've paid much more for exchange data than you can ever make back through the trading. meaning CFDs are a more flexible starting point. So in summary, basically this is the evolution of any standard trader. They are lured into the market by your standard broker-dealer who basically trades against customers, makes a ton of money by offering CFDs and advertises a lot more. That's the reason why you only see advertising from Iron FX, and you know them better than me. Once you've learned that advertising is not as shiny as it looks, you probably look for a pure broker. In our case, we do list our CFDs are not kind of OTC products, but actually offered on exchange via basically via the exchange from the liquidity provider. So it's really a futures contract where whereas other CFDs tend to be over-the-counter products. But then sooner or later, if you really trade larger sizes and you want to go for tighter spreads and so on, then you end up with futures. So once your account is large enough, but not before, futures are really better. So again, this was really the end of the planned webinar. I don't know if you have any questions or suggestions on anything to do directly with the topic today, or anything more generally Darwinex. In the meantime, I would like to reiterate that we have made a firm commitment to start offering futures, and we will pretty soon start basically to be in a position to offer futures trading. The sequence will be just futures, just trading, basically only execution, then execution plus the diagnostic, the investable attributes, and then after that we will embed fully blown futures-based Darwins, just the way we have done with Forex. So if any of you is keen to start trading, we will have a very competitive pricing from the outset, and we would be very grateful for anybody who helps us polish the offering. There's no real technological risk as we're using third-party technology, but it's just making sure, that everything's working as it should when it comes to funding the account, withdrawing money from the account, and that sort of thing. So do let us know. And yeah, that seems pretty much it. So unless anyone has any questions, I would like to thank you guys a lot for being again with us. And so there'll be more webinars programmed in the next couple of weeks. We will probably stop a bit in August as a lot of people are on holidays, but rest assured there'll be more and better coming over in the next months as we ramp up with a very exciting functionality roadmap towards the end of the year. Okay, so there you go. I think we're done, and you don't seem to have any questions today. So thank you so much, everyone. Wishing you a very enjoyable weekend, and it's always a pleasure. So take care and best wishes. Bye bye.